Hi everyone, my name is Zhang Shanyao, and in this presentation, I applied the ratio analysis to explore the mismatch in ROE and PB ratio of GMBY company. And I found that GMBY is a company with investment prospects. But if investors want to buy its stocks, they need to further consider their decisions based on the cash flow and the liquidity issues. So I selected 11 apparel companies listed on Hong Kong exchanges and made this matrix based on the data from Bloomberg. It shows that GMBY has an obvious mismatch with a low PB ratio and a high ROE. It means that this company may be undervalued. To further explore the GMBY's performance, I applied the ratio analysis. Considering time series and cross-sectional analysis, the ratio over 5 years and two competitive companies, Ika Fashion Holding Limited and China Lilang Limited, are selected to be the comparison benchmark. And for the overall profitability, GMBY has the highest ROE and ROA, and the performance grade in profitability. However, GMBY is the highest in terms of leverage caused by its highest equity multiplier and risks. From 2019, since the ROA is all in declining trend and the equity multiplier is rising, more consideration should be given to the future profitability and the sustainable development prospects of the apparel sector. For the operating management, GMBY's gross profit margin indicates that it has a reasonable price premium that the product achieved in the market. And its EBITDA margin has been stable through the 5 years, and it means that its administrative costs are relatively effective. Asset turnover is a key indicator of investment management and how effective the firm's management is. And it has two parts. The first is working capital management. The working capital turnover ratio indicates that GMBY has potential future liquidity issues. Lower days of accounts receivable are beneficial to GMBY's cash flow. And its high accounts payable turnover ratio means it pays the suppliers faster than its peers. Furthermore, this ratio in decrease trend suggests that GMBY cannot make good use of suppliers' credit and should enhance proactive management of short-term debt. And the other part is long-term asset management. While GMBY seems to be doing well in terms of its peers, attention should be paid to whether PPE turnover stops its downward trend. And for financial leverage, it has three parts. The first is liquidity. The GMBY's current assets and accounts receivable is not sufficient to cover the increase in its current liabilities, but its cash has shown an increasing trend in the last 5 years. Hence, GMBY's liquidity in general is poor, but it is improving in terms of cash. And for the solvency, the lower debt to equity ratio and debt to capital ratio indicates lower risk. So for investors, GMBY's low levels of these two indicators are favorable. And last is the sustainable growth rate. As a firm's ROE and its dividend payout policy determine the pool of funding available for growth, GMBY's funds available for reinvestment in the business will be limited to a certain extent, which implies that GMBY currently has no new business to invest in. Thus, GMBY has had a relatively stable high dividend payout ratio for the last 5 years, but this may not represent that its dividend payout ratio will remain at the same level in the future. And moreover, its sustainable growth rate has been volatile and consistently low. So even though GMBY has a mismatch, whether to invest or not should be further considered for investors. So my presentation is over. Thank you for your listening. Thank you.